Every month, I do a portfolio update where I go over the value of my dividend stock portfolio, holdings, dividends paid, dividends year over year, and so on. In this video, I want to go through each holding, showing you the average cost, how many shares I own, the return, and a small opinion on what I think about the holding. This video is going to be a long one, so if you don't mind helping a small YouTuber grow on his YouTube journey, all I ask you is to like, subscribe if you haven't, and watch to the end. Let's continue. Let's start with Apple. Everyone knows the technology consumer staple, so this company needs little to no introduction. I own 4.6 shares with an average cost of $112, accounting to 4.58% of the portfolio. The total return from this holding is 103%. I do like Apple and how they revolutionize the hardware through smartphones, computers, and also creating other cool technologies. Apple knew that eventually they will need to step it up in the software section, as eventually their hardware could face low sales volume, and Apple executed perfectly. Their software is a growing revenue section, and that sustains the cash flow of the company. Now, what I am not liking about Apple is the lack of innovation from their main hardware products like the iPhone. The lack of game-changing features are slowing the sales to a certain extent. Fundamentally wise, the company is doing okay, but it is something to keep an eye on for the long term. Apple is not as explosive as it used to be. The next company is Colgate, a multinational consumer products company, primarily known for its leadership in oral care, personal care, and home care products. Colgate has a strong reputation for being a stable and reliable dividend-paying stock, attracting long-term investors. It typically has a steady cash flow, making it a conservative but solid choice for portfolio diversification. I have 8.38 shares of Colgate with an average cost of $73. This holding represents 3.40% of the portfolio and a total return of 30%. Colgate has treated me pretty well. As mentioned, a conservative holding, but it has produced a decent return and consistent dividends. Colgate was one of the key factors that reduced the volatility of my portfolio during the pandemic. This is a company that I won't aggressively buy more shares due to the slow growth, but it is a company that I am planning to hold for a long time. Now we have the beverage giant Coca-Cola, one of the most recognizable brands in the world. Coca-Cola has remained dominant for a few decades now despite intense competition. This is a small holding in my portfolio, 3.22 shares with an average cost of $48. The allocation is 0.91%, making this holding one if not the smallest holding in my portfolio. The total return of this holding is 37%. The reason why my holding with Coca-Cola is so small is because there's better opportunities out there. Coca-Cola brings stability, defensiveness, and predictability to the portfolio. If Coca-Cola had a snack brand within its line of products, I wouldn't have a larger position. Also, living in the current times where people are drinking less carbonated drinks, I'm not seeing Coca-Cola expanding into healthier options, which could be a growth driver of revenue. The position will remain as it is unless things change. Now we have one of the most famous dividend payers within the community, Realty Income, also known as the monthly dividend paying company. Realty is a real estate company fully focused on the triple net lease business model, which means Realty rents the real estate, but the tenant is responsible for property taxes, insurance, and maintenance, while Realty collects rent. This reduces the risk and operating expenses of Realty Income. I currently hold 21.91 shares of Realty Income with an average cost of $57. 8.95% gain total return, and an allocation of 5.72%. Some investors don't like Realty Income due to the focus on retail brick-and-mortar businesses. Personally, I don't mind, as Realty's income portfolio is so vast and diversified that those businesses are a small percentage of the portfolio individually. As long as Realty continues to collect nearly 100% of rent and continues doing acquisition, they should be doing okay long term. As of today, the company is still expanding into sectors of businesses like the Vegas Strip, for example. I heavily bought into this holding when the interest rates were rising, as it makes the return of businesses lower. Therefore, they drop in share value. Interest rates won't remain high forever, so eventually this will reverse, increasing the total return of this holding. Procter and Gamble is a leading company in the consumer staple sector, with a stock that has historically been known for its stability and strong dividend payouts. The company's growth may not be as explosive due to its mature market position, its steady performance, and financial discipline, making it a solid pick for conservative investors. Now, the company competes with two of my holdings, Colgate and Kimberly-Clark, but Procter and Gamble has a vast portfolio of brands across beauty, grooming, healthcare, fabric, and home care, giving the company a competitive stance to remain relevant against the competition. Procter & Gamble is another small holding in my portfolio, just 3.02 shares, with an average cost of $133, accounting to 2.16% of the portfolio. I have a total return of 26% in this holding. Now we have the trash company Waste Management. This company has a simple business model. It involves collecting, transporting, and disposing of waste materials. It also engages in recycling operations, producing renewable energy, and various sustainability initiatives. The company benefits from a strong, stable demand from its essential services. When we talk about stable demand in waste management, we mean like a subscription-based service. Humans generate a lot of trash, and someone needs to pick it up consistently. So when we have urbanization expanding and regulatory tailwinds that increase regulation of waste disposal, this is a key point where consumers subscribe to the waste management services. I have 4.15 shares with an average cost of $152. Allocation is sitting at 3.68% and a total return of 35%. Another consumer staple that I have in my portfolio is Clorox. Compared to their peers, Clorox fills those little gaps that other consumer staples don't. Regardless of that, it doesn't put the brand portfolio of the company to be a top contender. Clorox has a slightly slower growth than other consumer staples, so this company offers stability and predictability. If I were to sell a company from the portfolio, unfortunately, Clorox would be one of them. I currently own 5 shares of this company with an average cost of $144, allocation sitting at 3.33%, and a small return of 8.78%. Now we have Kroger, one of the largest grocery retail chains in the US. Supermarket businesses are pillars of how humans get food in a convenient way. The margins of these businesses are minimal per product, but since they consistently sell a huge volume of products, those margins stack up. In my opinion, Kroger is the cheapest chain to invest right now. Competition like Costco are overvalued, and Walmart seems extremely mature for growth. Kroger is still in the expanding phase and bringing decent margins compared to their peers. They are heavily invested into tech like online shopping and consumer trend data, which could allow additional growth expansion for the business. I own 17 shares of Kroger, accounting for 4.26% of the portfolio with an average cost of $44. Total return is sitting at 28%. Kimberly-Clark is a global consumer products company best known for its leading brands in personal care and tissue products. This is another consumer staple company also known for its predictability and defensiveness. I had this holding for a while, and despite having low volatility during market downturns, the holding overall has not performed as good. If I ever do a portfolio recomp, this will be one of the holdings that will be eliminated from the portfolio. Now, this is a small holding. It only takes 2.36% of the portfolio, 4.10 shares with an average cost of $127. The total return is only 6.89%. So as mentioned, this position has brought defensiveness and cash flow, but very little total return as the dividend is invested somewhere else. Now we have one of the largest coffee chains in the world and one of my largest holdings as well, Starbucks. This is another world-class company, and I won't do an introduction for this one. I started heavily buying this company when the union tension was at an all-time high, and the CEO at the time canceled a 80 billion share buyback to address the situation. The stock price plummeted, but the fundamentals didn't change, so I started buying. I hold 18.33% shares with an average cost of $81. Translating to 7.54% of the portfolio. My total return with Starbucks is 18%. The largest bank in the US, JP Morgan Chase. This is the only bank in my portfolio just to have an exposure to the banking sector. This sector is a risky one and runs mostly on customers having trust in the bank and not taking their money out in large quantities, also known as a bank run. This is a holding with exceptional returns within my portfolio, currently having 5.95% shares with an average cost of $118, taking 5.60% of the portfolio. Total return is sitting at 86%, which is a decent return. Next company we have is Home Depot, a cyclical home renovation company that doesn't need to be introduced as well. Home Depot is a position that I bought a long time ago and never bought again since their stock price recovered. The last time I bought a tranche of this company was in February 2023, so more than a year ago. I haven't been able to encounter a dip and add additional shares. I own 1.25% shares, which is 2.12% of the portfolio. My total return with this holding is 40%. The next company we have is the pharmaceutical giant Johnson & Johnson. I own this company pre-Kenvue split, so it's been a while. Being in the pharma sector adds an additional layer of risk that I am willing to take. This company will do okay long term, but it has some hurdles like pending lawsuits that diminishes the cash flow of the business. Despite having this company for a long time, the returns are not good. My total return is minus 1.27% while holding 7 shares, composing 4.80% of the portfolio. Next, we have Nike, a world-class company that is pretty hard to not recognize. Nike has dominated in sports in the last decades, keeping a margin with its competition until the recent quarters. With the boom of run clubs and new brands, it caused Nike to lose some market share, and this is because they were investing in other lower growth areas like the iconic brands like Jordans and Air Force and removing shoes from their stores in order to push online sales. This didn't go as expected. Nike had a weak sales and bad marketing in the running space, forcing the company to even change the CEO to someone who knows the company better. So it's safe to say that Nike is under construction. I own 7 shares of Nike, which is 2.35% of the portfolio, so this is somewhat a small holding. I am currently down 8% in this position. Now we have the other REIT of my portfolio that people barely talk about, Digital Realty Trust. It focuses on owning, acquiring, and managing data centers globally. As the demand for digital infrastructure grows, particularly with the increased adoption of cloud computing and artificial intelligence, Digital Realty has positioned itself as a key player in providing the physical infrastructure needed to support these technologies. Now, this company has been phenomenal in my portfolio. My average cost is just $96. 7 shares, and a 5.86% allocation. My total return is 88%, positioning this company as one of my top in terms of total return. The other pharmaceutical in my portfolio is AbbVie. It was formed in 2013 as a spin-off from AbbVie Laboratories, with the goal of becoming an independent company dedicated to pharmaceutical products. AbbVie's portfolio covers a broad range of therapeutic areas with a significant emphasis on immunology, oncology, neuroscience, and other specialty fields. I started buying this company at the beginning of 2023 after slightly high-grading my portfolio, and it was a decent bet because that same year, the patent for the AbbVie's Humira product was about to expire, meaning that other companies will start selling their generic version. As of today, we can see the dent in the cash flow of the business, but they weren't as bad as people thought. AbbVie has 2 more products called Skyrizi and Rinvoq, where investors are having a high hopes that both products will take the companies to a new high. About my position with AbbVie, I have 6 shares with an average cost of $142. It takes 4.78% of my portfolio and currently have 31% gains in total return. One of the tech companies in my portfolio focus on semiconductors, Texas Instruments. This is another holding that entered the portfolio around the same time as AbbVie. The competition in this sector is intense, and Texas Inc. has been able to maintain it. Despite dropping in share price due to lower free cash flow, the company has treated me decently. The drop is due to the company creating a new factory to continue developing and expanding their products, which in the long term is good in my opinion. My average cost is $166 while holding 6 shares. It takes 5.28% of my portfolio and the total return is 25%. Hershey is another consumer defensive company in my portfolio. This company is simple and straight to the point, and that is to sell sweets and salty snacks. That's it. It's currently my largest holding with 11% allocation. I started heavily buying into this position when the combination of cocoa prices rising, Ozempic, competition, and increase in capital expenditure, all of that made the stock to plummet. But to my eyes, Hershey's was doing okay. The fundamentals of the business were intact. The holding so far has been a roller coaster depending on the time frame you see it from. At one point, I was down around 20%, then down by 5%, and now I'm currently down by 14%. My average cost is $212 with 14 shares. Another consumer defensive and long-term rival of Coca-Cola, Pepsi. It is similar to its rivals in many ways. The main difference is that Pepsi owns Frito-Lay's, which gives them an edge in diversification, making it a beverage and snack business. My average cost is $172 with 5 shares, making it 3.64% of my portfolio. Total return is somewhat flat, minus 0.58%. Now we have one of my favorite holdings, Visa. Visa is not a bank, lender, or card issuer. Visa's main business line is to facilitate payments transactions fast, efficiently, and securely. Simple as that. It's one of my core holdings that I'm planning to hold for a long period of time, and I'm very pleased that I was able to start a position with them. My average cost is $259 with 4.73 shares, taking 5.67% of my portfolio. My total return is 8.44% with this holding. Automatic Data Processing is a global leader in human capital management and business outsourcing solutions. Primarily provides companies with services such as payroll processing, talent management, time tracking, and employee benefits administration. This is a very small holding in my portfolio, only 1.02 shares, with an average cost of $226. This position takes 1.25% of the portfolio, and I am up over 27%. The next company is Mastercard, and I'll keep it short and simple, as the company is similar to Visa, and I share the same opinion with this holding in terms of being a core long-term position. My average cost is $460 with 3.40 shares. It takes a little over 7.31% of my portfolio, so this is a big holding. The total return is 10%. And the last company in my portfolio, we have Google. This is another core holding along with Visa and Mastercard. I really like this company, their products, and how each revenue segment of this business can generate billions of dollars consistently. Google for me is a must-have company to hold in your portfolio. It has products that are used worldwide, generate tons of cash flow, market-beating returns, and it has monopolistic characteristics. As part of high-grading my portfolio, I've been slowly adding small tranches. My average cost is $165 and I own 3.76 shares. This is 2.63% of the portfolio. Currently, my total return is flat, as Google has been calling the attention of the DOJ to break up the company, and that caused the company to give up some gains, but that doesn't concern me at all. Long term, this company will do fine. And there you have it, all my holdings from my 23,000 portfolio. This portfolio is not set in stone, and as time goes on, I will consolidate some holdings and increase the allocation on others. I want to continue increasing my core holdings, therefore increasing the quality and taking the portfolio to a new level. Hope you enjoyed this video. Hit like to help my channel grow, subscribe, and I'll see you in the next one.